Hear me? The screen looks funny to me. Can you even see me? Can you hear me?
Yes, I can.
Oh, okay. All right, good. First time I had Zoom cut out on me today in a different class. I never had it before. I know this one kind of looks funny. So, okay. So those are the three things that we're going to kind of do today. So the first thing we'll do is the classical sampling. I started working on this. Wait, what is this, number 2? Okay. Oops, that's not right. Let's check that one. Okay, so you should have got audit values of 240 and 220.
Yes.
The wrong one there. This is 240. Finding errors in mine. I should be marking this down. Oh, lost a point there. Okay, so mean per unit. Take the audit average. You ignore the book average for this one. You'll notice it's only audit. You know, we got our numbers. Our numbers are more persuasive than numbers that someone hands to us. So we will go with those, and we find that it is it's overstated by 100,000. We're saying it should be 2,400. They're saying it's 2,500. So we're saying it's overstated for that one. Okay, down here, I didn't finish this. Times 2,500,000. $2 million. Oops. $273 probably. My calculator is. Okay, so this would be the projected value. That. And this would have a projected misstatement of and this would be an understatement. Because we're saying this is they should have 2,227,000 and they only have 2,500,000. So we're saying that they're understated by 227,000. And difference estimation. So this is minus times 10,000 items. So 240 minus 220 is 20. Oops, it's still 20. Equals 20 or 200,000, I should say. Now this, oops, is the misstatement. So what they're saying is that everything is misstated by by $20. So if we have 10,000 of those things, it's a $200,000 misstatement. And notice that we're saying that they're understated because we say it should be 240, they're saying it's 220. So this would be not weighting up right. Understatement. Spell mistake. Yeah, so this would be, and this is a kind of an unusual one in that you'd have the three methods. One shows a overstatement, two shows an understated. Any question on that?
Yes, I do. So as an auditor, which one do you use? Because right now you have two giving us the same and one giving us different.
Yeah, that's an excellent question. And actually, in the CPA exam, they never used to kind of go into that. And now, from what I understand, they are. And that different ones are more useful in different situations. Mean per unit is good if they are, if all the items are of similar value, it's good. Or
if what is similar value?
All the items in the sample.
Okay.
So if they're all like $500 or $600, around there, then mean per unit is a good one because if the closer the average is, the better. If you remember your the statistics, when you get, when things are really all of the same price, it's a very tight little bell curve thing. If they get really varied, some things that are $60 and some things that are 6 million, you get this huge bell curve. So if they're closer in, the mean per unit is a good one to use. It's also good if the client's records are such that you can't rely on them. If you don't, it doesn't make any sense to get a book value if they're just a complete mess. So if you can't get a book value, or the book value, is very unreliable, mean per unit's a good one to use. Why? Because these other ones use the book value. If this number is garbage, this method is going to be garbage. If they're that far off that you can't rely on them at all. Missing numbers, transactions not recorded, all that kind of stuff that you might just go on your own because this is one that doesn't have any. Ratio estimation is probably the most useful in most situations, especially if you have a little bit wider range of, $6 and $6 million accounts. It can handle that okay, because ratio estimation, I don't know if I may have talked about it. Ratio estimation means that items are usually off in proportion to how big they are. So for instance, you wouldn't expect a $60 account to be off by $3,000. A $60 account might be off, but it's probably going to be off by $5, $10, whatever. Whereas an account for $100,000 might be off by $3,000. So the larger accounts will probably have larger errors. Smaller accounts have smaller errors, and that's probably the way most errors happen. If you bought something for $60 and they sent you a bill for $3,000, someone would be mad. So so that one is probably the most useful. If you're unsure and you have pretty good numbers for the book, the ratio estimation is not that one to use. Difference estimation is good when things will be off by the same amount regardless of the size. So it's kind of the opposite of ratio. Ratio says big things are off by big amounts, small things are off by small amounts. Difference estimation says if it's off, it's going to be off by the same amount in every account, whether it's a $60 account or a $50,000 account. So for instance, let's say that there's a handling fee. And sometimes the handling fees get added in, sometimes they don't. Maybe it's a $10 handling fee. You know, sometimes whoever's doing the order doesn't put in the handling fee of $10, or they don't apply it for it. It's whatever, you know, the policy's not clear, and some people do it, some people don't. So that the $10 handling fee maybe is, it could be off on a $60 account, could be off by a $60,000 account, the $10 handling fee. So that the amount that's it's off by is probably pretty similar. That's when you use the difference estimation. So there are definitely ways, you know, definitely ones that you use in different situations. If you can rely on the book values, in my humble opinion, this is probably the best one, the ratio estimation. Just because it makes more sense that small things are off by small amounts, big things be off by big amounts. You know, from doing auditing, that's kind of what I've seen in doing it. Maybe a little bit biased about it, but yeah. So yeah, so there are different ones that you use in different situations. And by the way, they you know, it is auditor judgment of which ones you use. So yeah. And this type of sampling, though, this is, you know, this kind of sampling could actually be used for anything. You're weighing the ducks on a pond, you know, if the ducks are all about the same weight, you use a mean, you know, mean per unit estimation. That would be, you know, what you'd expect to get a number for. What was the average duck weigh? I don't know. You go and scoop them up and weigh them and put them back in, and you know that you can figure out where they are. But yeah, and you'll notice that, you know, this is the same no matter what one you use. This doesn't really matter. I shouldn't say it doesn't matter. This doesn't give you an answer. It's how you take this and projecting it. That's what we're talking about, is projecting it over the population. Okay. Any other question? That's a good question though. Because there are different, you know, different ones in different use. Okay, well, I think I'm going to jump to the Anthony Fraud video. And I should probably set this up a little bit. Anthony is my brother-in-law. I always joke that it's my brother-in-law story. But really good guy, really, you know, honest guy and all this stuff. And he got caught up in a bad company, bad situation. And this is kind of his story about how it came about. And I remember we had some family get together, and he came over to me like, you know, I want to tell your students about this. You know, they got to know about this kind of stuff. What kind of stuff goes on? Okay. And so he came in and he talked for about, I think I had him scheduled to talk for like a half hour. I think he talked for the whole class. I think it was 3 hours. But anyway, and we filmed it. It's the film's a little bit dated. This was made in 2006, so it's a little bit grainy. But anyway, he talked about his experience with a company that you know, wasn't doing things the right way, and you know how he kind of got caught up in it, and kind of a cautionary tale, but also, you know, he said, you know, you gotta let people know that to realize when they're in these situations, you can't necessarily stop it by yourself. You know, I mean, you can, there's whistleblower stuff now. There's a lot more stuff than there used to be, but you know when you're in that situation and know that, you know, you got to get out of that situation, basically. Okay, so there should be a handout. That's what I just did. Let's get rid of that one. Anthony Fraud handout. It's this kind of just a fill-in one, and we'll have a drop for this one. And I'm not sharing my screen. I'm not a very good sharer, am I? Okay, so this is the handout, the Anthony Fraud video. handout. You also, if you just want to write on a notebook paper or something like that, and you don't have to rewrite the question. If you just want to write on a notebook paper and just write one, answer it. Don't rewrite it. Just one through, I think there's 10. Or you can type it right into this thing and turn it back in. However you want to do it is fine with me. But as you get kind of go along the video, kind of some of the stuff will be answered. Okay, so let me see. I gotta find the video now. Okay. I think this is permanent. I think there's actually 2 of these. I think I'm going to try to use the better quality one. I'm not sure if it will. Go through okay or not. I'm kind of loud.
I was answering an ad in the newspaper after I graduated from college and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the US. They had just started. Started out as an assistant manager, became a manager.
Can you guys hear it?
They were growing fast. They needed young, energetic people, and ended up in a purchasing.
Yes, I can, but it's a little bit faint.
Okay, I'm sorry.
Corporate level position, didn't have to move around, and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion in merchandise a year, and I was one of many people there. It was a very large organization, which has only grown since I left. It was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen. And very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell their price, hopefully lower than everybody else, and make your thin margin in the middle roll off that. That's a very good question. When one thing about Aldi is that they are so structured, there's a very clear corporate ladder that you climb. As an assistant manager in a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. In my late 30s, thinking if I'm ever going to make a change, worldwide at that time.
I'm just going to start it over just
worldwide at that
so you can hear it maybe a little better. Is it a little louder now?
As low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the US. They had just started. Started out as an assistant manager, became a manager, a district supervisor. They were growing fast. They needed young, energetic people, and ended up in the purchasing department, which was a great steady position, corporate level position. Didn't have to move around and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion in merchandise a year. And I was one of many people there. It was a very large organization, which has only grown since I left. It was privately held. And that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen. And very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, That's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided when you would leave there?
That's a very good question. When one thing about Aldi is that they are so structured, there's a very clear corporate ladder that you climb as an. I'm a district supervisor of 5 stores, and then you get this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had. And one thing that I had never experienced, I mean, they were a publicly traded company. They offered me these things called stock options. And that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of company that Aldi was, and they were serious. They had the right package, and also something I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area, so I got to stay here. When I originally negotiated, it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also. So we set up an office in Northbrook, and I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all the purchasing into their corporate office in Texas. And it was something I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Louisville, Texas. The whole company moved. There was a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Louisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hansen, and talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they were a large company. I said, how are you going to finance these new stores? He said, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there. We did get 17 stores open. And again, they were going on well enough that they thought my services were better used managing all the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler is buying for. How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything is funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost. And that's where they got in trouble. This gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're gonna let them be vice presidents of private label for all of Fleming, and they'll buy it for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated. And these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th. This is the last time September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company, he couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information is 100% accurate. I have a lot of respect for the Wall Street Journal. It's a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, he finally reworked the language until it gets done and it gets put. So a few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion, as I recall. We negotiated for it. We had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name from the old blue light specials. But they negotiated for that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply to Kmart, could supply to Fleming, and could supply to the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. Ice cream was a big deal. Ice cream is the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen cakes at the grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it. Go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kim's Marigold had the plant. They had enough plants in different spots in the nation they could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated the deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They give Fleming Retail Group $1 million because now Chem/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate for their private label group. So we had $3 million out there. Now what happened was in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share, whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite, gets a handful of guys around and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make out 30 cents a share, you know, in a very short period of time and hit the projection that you've given Wall Street? You know, if you don't hit it, that your stock's going to tank, and people lose confidence in your company. You know, your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. You know, my response was always, well, let's be more careful with the numbers we give everybody. Nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company, and he sent very aggressive numbers to Wall Street. So we had a gap. And what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate $30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. It's cash. The money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we don't invest. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. So just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't even know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to him and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money because he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it? Shapiro, Mark Shapiro, is he on top there? Yeah. Yeah, Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Miracles about it. I said, oh, okay. I said, they know something I don't find. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold stating that this was some sort of rebate or something. And, at the same time, their sales guy signed the agreement, formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals I had done before, but now there was. And this is the way they did business. I mean, this was normal and it still goes on today. Super Value is the major wholesaler that does business this way, and CNS Wholesale, there are others. I don't mean, I'm sure most of what they do is above board, but there's potential for danger. I signed that agreement and we booked that money and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number.
And your options also.
And options as well. I mean, because it's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job. And, you know, after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company moved. And not only that, but when you move, Fleming was very generous with their relocation expenses. They had this executive relocation program. If you couldn't sell your house, this company would buy it for you and then sell it for whatever they could, take the loss. If you leave the company within a certain period of time, you had to reimburse them those relocation expenses, tens of thousands of dollars that I would have to pay out of my pocket if I left. The HR person said, you know, how are you perceived as a buying group out there in the world with Procter & Gamble, these other vendors that you deal with, and with some of your contemporaries, your other person groups? How is the Fleming group perceived? And my statement was that we were pirates. I mean, we don't, a lot of fun to hang around, but the guys around me would cut your throat at the end of the day. One of the guys next to me came up with this brilliant idea that, well, there's going to be shared savings now. Now that the vendors don't have to go to Troy, Michigan to call on Kmart and Louisville, Texas to call on us, they're going to save money. But we're going to be easier to deal with. The volume's going to be greater. They're going to save money. So they sent out a letter that said, congratulations, you're now selling to and working with this new larger company, larger purchasing organization. It's only going to cost you 3% of your total sales for the year. That's millions and millions of dollars, and hope for the best. We put enormous pressure on them. We did over $1 billion in business with Kraft alone. One of the companies obviously got fined is Kraft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming is a very important customer to Kraft, $1 billion in sales. And, if it meant signing a letter that, $7 million or $10 million would get funneled to Fleming somehow over a couple of years, we signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted it, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had worked hard for over 16 years revolving and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid, that those deductions were going to be repaid. My word didn't mean anything to them anymore. And I wouldn't. I would just tell them, so look, we're all in trouble. This is not going to work. If you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. Whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that, as elevates the cost, makes Fleming uncompetitive in the marketplace. And at the end of the day, that $450 million in cash flow that Mark Hansen was so proud of, it went away because these vendors said, we can't handle the deductions anymore. It's not working. We have to put you on cash in advance. And that's a death knell for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me when I was running those 17 stores at Yes Less, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea. Couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record. Okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed him in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with Davis, quite frankly. I mean, they hadn't made money for a few years, but when Hansen was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies. And as we looked at his history, he kind of did this at those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me, and another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too. And I was astonished one day when I came in and he was in the office next to me. I'm like, hey, why are you here? And Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in a position where I had to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them, for sure. We're destroying those relationships, and it's not right. I can give you one specific example. It's one of the companies that got fined. There's Kim's, Marigold, Adair. They got fined. The CEO got fined. Their chief financial officer got fined. Personally, they got fined, as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw at Fleming, was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other, see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street. We're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. Another startup opportunity in New York became available. Once again, we could set our corporate buying office here in Chicago. So we got the team that put the Yes List stores, several of us back together to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, it was a private company, it's one guy. The document that none of you ever want to see again and ever want to see your name on is this, it's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to a huge fine to the guy that worked right next door. His name's Al Abood. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Al Abood was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you would never know. You can read about it, but it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I said, at the end, it can make you stronger. I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hansen, the CEO, he hasn't been charged with anything. But it's very difficult, you know, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom, or it's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings and it's all verbal. It's never taped, but the direction is completely clear. They're walking into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so they can hit the earnings and stuff on Wall Street about. None of that is in writing, other than the notes that the guys take who were in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hansen, this is what he came back to us with, that we need to, you know, make $30 million here to hit the number. What you really judge on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he gonna sign it? Is he gonna sign it and say, yes, I believe all this information is 100% accurate? He did sign it. And I always thought that that would come back to haunt him. To say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway that it wasn't accurate, most of it was manufactured. And it's so interesting when I used to hear Ken Lay, who would just insist on his innocence, you know, and just think, you know, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that, you know, the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that this is just the way of doing business. There's just some sort of a mental illness almost when it comes to that. CEOs get it sometimes. It was frightening to watch. I walked away from big bonuses just doing what I did. Other guys that stayed, even a few months after I was there, I was 2 months away, I think, from like a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. Who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality product at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands up and said, take it from there and go. That's kind of the mode I was in right at the time I left. I would have found something else at some point. That was not sustainable back then. The guy that had worked for Fleming for probably 27 years was a merchandise manager there. And he stayed right till the end. And it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement, account with the company was all in jeopardy at that point. His wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. But there are personal tragedies involved when things like this go on. It might have worked if Fleming had ever purchased Kmart the way Sears just did. Maybe their stock would be $100 like Kmart's and Sears is right now. That didn't happen.
Stop that. Okay. Yeah, so that, that was kind of a wild video, but yeah, it was, talk about a crazy scenario. You had this company that was actually profitable that went bankrupt, and it went bankrupt within months. I mean, we're not talking about like 5 years down the road. It from the time that the bad uh, Wall Street projection that Mark Hansen gave until the company was bankrupt was 9 months. So a profitable company, 100-year-old company, billions of dollar company went bankrupt by one person's bad projection to Wall Street, and it sunk the company in 9 months. Um, and in you know now other companies picked up pick up the scraps on that, but such a crazy scenario. But that Mark Hansen, he had done the same kind of things. He went to PetSmart, did the same thing, and his whole thing was he would go into these places and cut the prices by they paid out to vendors, so the company looked very profitable, but the vendors would pump the prices up. So the next year at PetSmart, he almost sunk PetSmart. He cut the prices. The first year it looked great. Well, look at all these profits. He sold $16 million worth of stock. And then the following year, the PetSmarts were half empty of merchandise. They couldn't get anyone to sell them anything. So he actually had a kind of a track record of that. Not to the extent that it happened at Fleming, but so it was one of those strange things. Now, any questions on any of it? You guys go through the questions. Let's see here. Oops. Let's get rid of that. Nope. So any questions on any of that? You guys okay with it?
Yeah, so with the questions, are you going to upload the video so we watch it again and use it to answer the question, or is just like in-class exercise?
Yeah, in class, like say again, yeah, if you want to just do it on notebook paper, something like that, that's fine too. But yeah, these are, so I'll put a drop for this in the the submit assignments here. But yeah, very strange scenario. And here, by the way, number 9, I don't think that they covered this in the video. Why wasn't Anthony charged by the SEC? You remember in the video, he couldn't get them to sign the letter. Someone else did. Yeah, Shapiro did. So because he couldn't give it, if they had signed the letter when he asked them to, he probably would have been charged. And he would have been participating in it, in the fraud, even though he had no idea. He didn't know. He quite honestly, he's not even a business major. He's a journalism major, an English major. So he didn't. But that's the thing. He said, you got to realize that you're in a bad. He had no idea he was in such a dangerous situation. That hey, you can not only get fined, you can go to jail for this stuff. But so that's why one of the things that he said, he got blindsided by it. And anyway, there's I sent out another document that brings up another point. There's actually, and this just came up. This came up the other day. This is last Friday. This came out. Kraft Foods. In that Fleming case, Kraft Foods got fined, and the different members of Kraft Foods were got fined individually as well as the company. Same thing. This one lasted years long. That's a little bit longer than that, but basically they would. What does it say here? We should. Here. Faking supplier contracts to get discounts the company hadn't earned. It's exactly the same thing that Fleming did. So here's the point in this. This is one of the weird things about fraud. You would think people who got caught doing something and got fined, went to jail or whatever, that they would stop it. Okay, I guess I can't do that. That is not generally the method of operation for people who commit fraud. Recidivism of fraud, of people that would commit the same crime again and again and again, is extremely high. I think only sex offenders have higher amounts of repeating crimes. It's a crazy number of how many of them do. So let's see here. So one of the things about fraud, though, is someone who has been convicted of fraud, they generally don't stop. It isn't like they go, okay, well, I learned my lesson, and I'll stop doing it. They generally don't, and it's a very strange thing. People who commit fraud are really a strange part of the criminal population, in that they're usually better educated. They're college educated often. They look like you and me, and they do these frauds, and once they start, they almost can't stop a lot of times. And even when they get caught, they just go back and do it again and get caught again. And it's a very strange kind of a mental thing to go through. All right, any questions on that? Okay, I think that it's really good to realize like how this stuff comes about, and especially knowing you're in that kind of a position. You're around people that are doing things that are unethical. To some extent, you're surrounded by like when you're in high school, the whole world was in that high school. Everyone you know was in that high school. But you tend to do what everybody in that high school does, and it's the same kind of thing that you run into in these businesses. That it's a social thing. They had what's it called? Parmalat, I think, was the biggest fraud in the world. That was a European fraud, $12 billion or something. Well, yeah, for a company, anyways, not Madoff stuff. But anyway, they indicted 76 auditors for fraud. Not people inside the company, external audit, 76 of those. You say, how do you find 76 corrupt auditors? Well, it's because they come into the organization's already doing it this way. They go along with it. So it's a very insidious thing that can happen in those places. Okay, we should probably take a break, and then we'll come back, and then we'll start going through the chapters 1 and 2 handout. If you have any questions on that, though, feel free. But so let's come back at let's see where we're at here. Well, let me pull up the handout about. Okay, so let's be back at 7:04. How about 7:10? Put the PM there. Okay. So let's go ahead and take a break. We'll be back at 7:10, and then we'll start going over the chapter 1 handout. Hello. Okay, so what we're going to do now is we're going to briefly go over the assertions. What are the assertions? Assertions are when management hands you something, especially when I'm thinking about most of these are the financial statements, but it could be records or anything else, that there's sort of like an assumption that these are on the up and up, that they're correct. In other words, when they hand you the financial statements, it's them asserting that these are fairly presented, that they're complete, that these accounts exist, that they're not leaving anything out. That's all kind of given as an assumption on your part that these are on the up and up. So on their part, it's an assertion that, hey, here's our financial statements, and the assertion is that these are fairly presented. Okay. So what we have to do when we go through an audit is say, okay, well, there are some things that, certain types of things that we want to check to make sure that these financial statements are fairly presented. What are those specific things that we're looking for? Not just, look at this account, look at that account, but look at specific things in that account, the different accounts, is what they're looking for. So that's what they're kind of talking about in these assertions. So when management hands you something, there are assertions. Okay. And assertions used to be kind of easy. Now they've kind of broken it up into a few different areas. And basically, they've broken it up into the balance sheet, income statement, and then footnotes. And so that's what we're kind of looking at for these. So balance sheet is at a period of time. It's at the end of a period. And so these are the assertions. So what does this mean? So completeness. So on the balance sheet, we want to know that everything is there. Is this all of the accounts payable? Did someone get a phone bill and instead of entering it in the system, they put it in the drawer and lock the drawer and don't put it in the system so that they're, the liability isn't shown on the balance sheet. All right. So is it complete? Do you have everything here? Are these all the assets you have? That sort of thing. The next, and these two are probably two of the biggest ones. These for any of these. Completeness and existence are two of the main ones that, is the account too high or too low, right? Existence, if you have these things if you have these assets on your books, do you really have them? Do they exist? You say you have, 18 delivery trucks. Do you really have 18 delivery trucks? Or do you have 14? What, do you have, so you're always looking to see whether it's complete, that everything's there, or see that they're not putting too much on. So this is sort of like putting too little or too much into the account. And these are the two that a lot of time we'll do the testing to those too. Not that you don't do these other ones also, but these are the two that really hit basically every account almost. Okay. And here is the second one. That's balance sheet. The next one is the income statement, and that's the transaction classes. You notice the balance sheet's at a point in time at the end of the year. At the end of the year, what is the assets? What are the liabilities? And well, what's the equity? Ending at. Income statement stuff happens throughout the year. You make sales throughout the year, so you have transactions, sales, pay vendors, pay bills, pays all that other stuff. So these are ongoing things throughout the year, and they're transactions that are occurring. Not a point in time, over a period of time. I do it. And here's the weird one. That one. That one's weird. Why? We never say that financial statements are accurate. We never say that. We say they're fairly presented, reasonable assurance, or they're free of material misstatement. We never say that they're accurate. So why is that one there? Well, that one is there because any given transaction that you look at, it comes with a management assertion that this is a real transaction, that it is accurately, recorded. So it's any individual transaction. We're not saying this about the entire financial statement. We're saying about the transaction itself. Any given transaction, there's the expectation that it was recorded properly. Okay. All right. The relevant assertions, presentation and disclosure, and this is a lot of this has to do with footnotes. That the footnotes are part of the financial statements, and you'll see that accuracy come in down here also. And the reason being is that the footnotes, if they're saying that they're using the LIFO method for inventory, for example, are they really using the LIFO method, or are they using some other method? So when they talk about accuracy, they say, okay, do the notes actually match what is going on in the financial statement? So that accuracy is not for the dollar amount. It's usually for a disclosure amount, or a disclosure of what the process is for whatever they're doing. LIFO, FIFO, straight line depreciation, or whatever it is. So this is for the AICPA. They break it up into 3 parts. PCAOB, this is what we used to have. This is what they do with the whole assertions, what they used to be. So you see that they kind of combine a few of them. And so whenever we do testing, though, this is what we're testing too, these assertions. The financial statements are really presented. Okay, now this might be I think we talked about this before, but I just wanted to make sure that we're all on the same page with this. And that is, we have this private sector, and that is the AICPA. And this is like many professions. They will have a private sector that makes the rules. And then the government agencies, adopt those rules to use as a basis. Whereas the actual private sector doesn't have any power over the actual enforcement. They can be very powerful just because of whatever they say a lot of times becomes the state law or the federal laws. So they are very influential, and that's true of the AICPA. I think I talked about it. Did we go over this before? About the accounting rules and the. I think we did, didn't we? I don't know. So they make generally accepted accounting principles. Oops.
Oh, I don't remember.
So they make GAAP. They accept accounting principles. They make gas. Oops. And they make the CPA exam. So they make the accounting rules. And they make the auditing rules. So accounting is the actual reporting of stuff that you guys done all your other classes. And auditing is what we're doing in this one. They make the rules for it. And those rules are adopted by different agencies. And so, for instance, the Joint Accounting Principles, the SEC tells everybody, look, you got to use their rules. They don't have any control over it themselves. They can't force a company to follow the rules, but the SEC can. So while they're private sector, they have no real authority, no governmental authority. I should write that in there. Big letters. So they make the CPA exam, but they cannot license a CPA. They're not a state. Just like they can't make a driver's license. They're not a state. States license people. So there is no governmental authority to the AICPA. They cannot enforce the rules. They can enforce the rules inside their membership that they can, at worst, they can kick you out of the club, but they cannot, they don't have any real authority as far as taking licenses away or anything like that from CPAs.
What about the CMA exams?
CMA is the Institute of the Certified Institute of Managerial Accountants, and it is, or actually, it's the Institute of Managerial Accountants. Yeah, it is not a license. It's a certificate given by that group. So a CMA does not have a license to do anything. The CPA is actually a license. It's actually a license. I should try to find mine around here somewhere. It's a license to actually do audits, whereas a CMA is not a license, but it is a certification, and it's a good certification. It's probably more useful for most accountants than the CPA. It's not as well known, but and it's not a license, but it's a good certification to get. Yeah, I think. I think Professor Benarsic is. He used to work with that. The students getting the CMA exam. But anyway, yeah. So CMA is a certified managerial accountant, and it's a good designation. Again, it's not a license though, and and you can't do auditing. The only time you can do auditing is if you have a CPA license.
Okay.
Yeah. But again, I would strongly encourage most people that have CPA licenses don't use them. I don't use them. I don't do audits. I did in the past, but not that kind of audits that I have to sign off on. I did internal audits. Okay, so government sector for states. So State Board of Accountancy. These are the people that do the licensing of CPAs. Oops. Can't start. So they make up the rules for licensing CPAs, and every state uses the AICPA's exam as part of that, licenses CPAs. Now, corporations are chartered by the states. So states also charter corporations. If you want to have a corporation, you go to the state and they have you fill out a form and you become a corporation. Now, you do have to follow state rules. Whatever the state has as rules for that corporation, you have to follow those. So the states, what do? They license CPAs. They also are the ones that will charter corporations, and then corporations are chartered as a separate individual, different from the owners. But you have to follow the state rules, whatever the rules the state makes for those corporations. So they do two things. They license CPAs so people can do auditing, and they also are the ones that give corporations their status, basically. Okay. Securities and Exchange Commission. And by the way, these corporations, this is for issuers or non-issuers. So I think we talked about this. Issuers are publicly traded, and non-issuers are privately traded. In other words, you can't buy their stock on a stock exchange. So states will do both of those. The federal government only has control over the issuers. So only those companies that are selling stock on the stock exchanges, those are the only companies that are under the jurisdiction of the federal government, the SEC. So the SEC can tell IBM what to do. The SEC cannot tell Joe's hot dog stand that is privately held. You can't tell them anything. Joe's hot dog stand can completely ignore the SEC. IBM cannot. So they make laws for issuers, and they're the people that, you know, as you kind of got from that video, they're the people you don't want to get into trouble with. I spelled federal wrong. We've got my spacing. There we go. Okay. No, I guess I don't need to put that in there. It's already in there. What am I doing? For corporation. Okay. So they make the laws for corporations. Sarbanes-Oxley Act. I don't know if everyone knows the history of that. It's probably a good thing to talk about. The history of the Sarbanes-Oxley Act. There's a company called Enron. I'll put this on the next page. Enron and WorldCom. Enron was a company, an energy company that had huge fraud. Before Enron, a big fraud would be like a $50 million fraud. $50 million fraud was huge before Enron. Enron had $1 billion fraud, more than $1 billion of fraud. Unheard of. It was like, you know, I remember it happening and people kind of looking around like, what? You know, $1 billion? How does that, how was $1 billion missed, you know? So Enron was kind of the first hit that, oh man, these big companies are, you know, how could a company this size be caught with fraud? This sunk Arthur Andersen, the CPA firm of Arthur Andersen. Anyway. All right. Arthur Andersen was the biggest CPA firm in the United States by far. Arthur Anderson is the biggest CPA firm in the United States by far. Enron case, when Enron hit and Arthur Anderson was the auditors, before Enron, everyone wanted to have Arthur Anderson as their auditors. They wanted the Arthur Anderson name on their financial statements, on the audit report. They had prestige. When Enron hit, you did not want to have Arthur Anderson name on your financial statements. Everyone ditched Arthur Anderson. Arthur Anderson went out of business. CPA firm sunk quick, like in a year. Arthur Anderson was pretty much gone. Like I say, 1999 or whatever, everyone wanted Arthur Anderson as their CPA firm. 2001, poison. So Arthur Anderson went out of business. The country kind of, they kind of get back. Okay, that was just this weird thing, this weird Enron thing. It didn't. Okay, it happened and whatever. It seems like the guilty people were all punished and blah blah blah. But a year later, WorldCom hit. WorldCom was even bigger than Enron, and that sent the market just tumbling. No one believed any of the financial statements anymore. So when WorldCom hit, it was really bad. That someone had to do something, or else we were going to lose the stock markets. Basically, no one was going to trust them. No one was going to invest in them. And that's where the Sarbanes-Oxley Act came in. Sarbanes-Oxley Act was an act that was floated around for years, couldn't get through Congress. Companies all said no, don't do that. Put pressure on people in Congress not to, pass this act. After WorldCom hit, these companies came back to pass something. Sarbanes-Oxley, fine, pass it. We're tanking here. We got to do, you got to do something. So Sarbanes-Oxley Act, and this came the Public Company Accounting Oversight Board, and this Public Company Accounting Oversight Board is basically control the auditing for publicly traded companies. Oops. So audit rules for people that audit issuers. Yeah, so this Sarbanes-Oxley Act was acted. No company wanted until after this WorldCom thing. Then companies were desperate for it. Okay. Most of the stuff we already talked about. Let's skip over that. This is the same same stuff we just talked about a little bit. But these are the people that make the changes. Financial Accounting Standard Board, they make the rules, they make GAAP. Governmental Accounting Standard Board, they make governmental rules. Not all of them, but a lot of the governmental accounting rules they make. Some federal government does. And Auditing Standard Board makes the. Oops. Yeah. Yeah, Johnny said the auditing standards, which we'd already talked about. See where we talked about this. Okay. Let's move on to types of audit. How many pages do I have here? Okay. Okay, types of auditors. Several different types of auditors. CPAs. Which we just talked about, and these are licensed to do audits of companies. I should say businesses. They don't always have to be companies. Okay. Internal Revenue Service auditors. You don't have to be a CPA to do internal revenue service auditors, but a lot of times they a lot of them are CPAs. The Internal Revenue Service, it could also be for state revenue auditing for state taxes too. Internal auditors. Oops. Audit company operations. This is what I was, by the way. The internal auditor. Internal auditing is this is when you work for inside a company doing audits within the company. So if you work for IBM, you'd be doing audits of different operations inside IBM. Trying to make IBM better, trying to make sure they're in compliance with stuff and all that kind of thing. But these are inside the company. And generally, as an internal auditor, you know more about the company than virtually anyone else in the company. You know how it works from the bottom to the top. It's a very good, if you want a good business experience, internal auditing is a great one. And those jobs are, they come up every now and then. A lot of those jobs have a lot of travel. I don't know if they do anymore. Maybe they don't anymore, but they used to have a lot of travel. So a lot of times people would, there was a kind of a higher turnover, you know, generally younger people would do those jobs, and then when they start getting married, having kids and all that kind of stuff, then they would tend to leave those jobs for something else. But, you know, the great thing was those jobs would come open every now and then. And so, you know, but anyway, I worked for Navistar, trucking, I mean, they make trucks, and US Steel, which is based out of Gary, Indiana. So I worked for those two for like 3 years, doing internal audit stuff until I got married, and I started looking for stuff more local stuff. So anyway, those were you know, they're very good things. And a lot of times they pay very well, and then again, you learn so much. You see every operation. You know, a lot of people never meet, you know, the chief financial officer or the CEO or whatever. I can tell you that when I did internal auditing, when I first started at Navistar, I think it was the second week, I was in a meeting with the CEO. You know, if you're new in a company, you never get that. You know, you're not gonna sit in a meeting with the CEO when you're there for 2 weeks, you know, out of college. But I mean, so you end up dealing with very higher ups in the place very quickly, and kind of seeing how things work. So internal auditing, I think, is one of those things that is kind of overlooked. But I look at it as it was an excellent learning experience. Okay, governmental auditors. GAO, Johnny, they used so Governmental Accounting Oversight Actually, I think they may have changed that name, but anyway, a lot of times you'll see in Congress, they'll half the time people having arguments with the GAO. The GAO is a government oversight that they have auditors go in and see if and how things are doing. So they have some government contract and they'll go in and see what their government contract is being followed or whatever. And half the time you have Congress people say, you know what I'm saying, the GAO, they know what they're talking about. They're bad people because, they don't like something that, some defense contractor from their state or something they, had put out an audit report critical of them. But anyway, the governmental auditors are also, I think governmental auditing has their own rules basically, because, there's only one Pentagon. There's only one State Department. There's only one Federal Reserve, there's only one of a lot of these things. And so you don't have a generally accepted, principles for them because there's only one of them, so. All right, types of audits. Why is this stuff dry? I tell you what, we'll do two more here. I think we'll finish up by doing another of the classical sampling things. Okay, types of audits. Financial audits. Done by CPAs. Oops, not CPSs. These are sometimes called examinations. So you hear companies saying they have an examination, they're talking about a financial audit. And they're basically to see if the financial statements are free of material misstatements. Reasonable assurance, but whether they're free of material misstatements. Okay. Tax audits. Probably don't need to go into those. You know what those are. Compliance audits. Actually, tax audits are a part of compliance audits. To see if you comply with the tax code. But compliance audits can also be, are you complying with a contract? Are you complying with a, with a government agency or whatever it is? So, well, tax audits are technically a compliant. There are also other ones. They're not, I'll put it this way, tax audits are not the only compliance audits. The most interesting one, to me, are the operational audits. And these are trying to make a company better. They will look at the if you look at the efficiency and the effectiveness of the operations. So are they efficient? And by the way, this is one thing that you don't audit when you do a financial audit. When you're doing a financial audit, if something's inefficient, I mean, if you notice it, you'll probably tell, the client about it. But you're not going to make any judgment on it. You're not going to put that in the audit report. If they have 3 people doing a job that can be done by 1, to some extent, that's not your business. If you're a financial auditor, external auditor. But if you are doing operational audits, the whole point is to find things that are inefficient or ineffective. And this is made for future improvements. I actually did a lot of these when I was in companies. A lot of times companies want to know, well, how, look at this as a purchasing function. Can we do this better? And you go in, you look and you make a report and saying, okay, you can make changes this way and that way or whatever it is, so you're looking at, this is kind of future oriented. Now, people get very nervous They have these operational audits for a number of reasons. First of all, it's looking at somebody's work and saying whether it's, efficient or effective. No one likes that. And second of all, people are worried that they might lose their jobs. You have 3 people doing this, and you can do it with one. Well, you don't have to be an Einstein to figure out that means 2 people are going. So this can be fairly difficult sometimes too. It can be confrontational at times, not always. But anyway, future improvements, it's aimed at that. Okay. Assurance services. Okay. So these are things that are usually beyond auditing. Auditing is an assurance service, but there are some things that are sort of on the outside, and the most obvious ones are going to be agreed upon procedures. Agreed upon procedures are when you, just what it says, you agree to do certain procedures for a client. So for example, so agreed upon procedures. So like if you are working, if you're doing an audit or you're working for a franchise, a company that franchises out their business. So they have all these other franchises that they are working with, and maybe they get a certain percentage, they get 6% of sales or whatever it is. So you get 6% of sales. Well, you want to know, are you getting 6% of sales? So you'll have them go take a look at a franchisee and say, okay, how much are their sales? You don't worry about anything else in their business. You don't worry about their payroll, their inventory. You just want to see what their sales are. So agreement on procedure would say, okay, go test and see if their sales are, they're showing all their sales, because we're supposed to get 6% of those. And we want to know how much they have in those sales. So agreement on procedures are just what it says. You're going to agree upon certain procedures. It's not a full audit, but you are attesting to something. You are saying that these are, on the up and up. But usually for just a specific thing, not the entire full-blown audit. Okay. Share screen. Okay. So agreement on procedures. There is another one called a review. And a review is sort of like a mini audit. That's not a really good term, but it's good enough for us now. So a review is like a mini audit. It's when you kind of look over the financial statements to see if there's anything glaringly wrong. And if you do find something glaringly wrong, you look into it. But if you don't find anything glaringly wrong, you put your stamp of approval on it. It's more passive than audit. And say, well, what do we do that for? Well, use it in this case. Let's say that you have a client that has net income of $130,000. They want to audit. Say, oh yeah, well, we can do an audit, and the audit cost $46,000. Does that make sense? Does it make sense to spend whatever 30-some% of their profit for the audit? No, it's too expensive. Okay, how much does a review cost? Well, review is much smaller, so review might cost, let's say, $5,000. It's still it's not as good as an audit. It's not as good of an assurance as an audit. But it says, okay, someone professional has looked over these financial statements and they haven't found anything. They didn't do all the testing. They didn't test every account and all that like you do for an audit. But they've looked over them and there's nothing that glaringly comes to their attention of being wrong. And if there was anything that they would have looked into it. So a review is a lot of times a cheaper alternative. Another thing about reviews, Okay, reviews. If we give a company, they'll put out quarterly reports. Hopefully they spell it right. The quarterly reports, these get reviews. So when they put out these quarterly reports, they get a review. And at the end, they get an audit. So, well, if you're doing an audit for a large publicly traded company, if this is an issuer, you'll notice something. That you're going to do 3 reviews for every 1 audit. So you are going to be doing reviews. If you're doing publicly traded companies, you're going to be doing reviews. You're going to be doing a lot of them. You're going to be doing more reviews than you're going to be doing audits. So every company will have a review every quarter. And then the 4th quarter, they'll have a full-blown audit. Okay, I'm going to skip this. I'm going to skip that. Okay, we'll finish this up. Okay, so let's stop right there. And I think, let's go to the, let me say this. I don't think we finished the, I tell you what, I'm gonna sign this for homework. I'll let you guys do this on your own. And we'll fill this thing in later at the end. So I tell you what, well, I'll sign this for next week. So for next week, let's do this one. And by the way, this is a lot of times more what you'll see for the CPA exam, how they'll word these kind of problems. If you get a bigger one, if you get a bigger one of these classical sampling ones, they usually do it this way. So they'll give you a sample size and they'll give you the total of the sample. So, you know, they won't do this. They'll just give you the totals, which is all you need, but you know, the detail is not there. So these are for the sample. This is the, you know. That's what you're going to use to find your per unit amounts. And again, these are the just the totals for the sample. So we'll say we'll assign 3 and 4. So what we'll do is, well, actually we talked about these. You know, you guys can finish this whole thing. Let's do that. If you have questions on it, you can contact me. So I kind of went over in the beginning of the the meeting, that of when these are appropriate. So you know, look back in the video if you're sleeping or something, which I don't blame you, and see what these are. But yeah, I'll assign this whole thing. Yeah, you guys can do this, I'm sure. And if you get stuck, you can email me and we'll go over it. So here's what let's see what we have for today. So turn in. And I'll put these up in a second. And the classical sampling. So you finish the whole thing. So this is, and I'll put these as a drop. Well, let me, I can't remember. I don't think I put anything in yet, have I? Let me see here. I did not. Okay, so I'm gonna build that. I'll show you how you do this. Here's an assignment. So the first one's gonna be the Anthony video.
With the Anthony video, are you going to upload it, the video itself, so we can watch it again?
Well, yeah, the whole thing will be uploaded in
Okay.
you know, and when I do the YouTube thing. They don't like us putting
Okay.
they don't like us putting video actually in Blackboard because it takes up a lot of space and you can actually slow down everything.
Okay.
They yell at us and say mean things to us. We'll make it due on maybe by Friday of next week. And again, you know,
Friday.
yeah, so the 17th. I give you time to work on it. And if you have any questions next class, you can go over them.
Okay.
And if it's possible. Unlimited attempts, and we do the highest grade. And I went past the submit. Okay, so the Anthony fraud video. So when you fill it out again, and if you just did it on notebook paper or something, that's fine. Do not rewrite the questions. Just put the answers in. And then I'll also do a, oops, not that, assignment for the classical sampling. Do it at the same time, not this Friday, but next Friday. 100 points. Limited attempts. Oops. Okay, so those two are in there. So you're gonna click on submit here. If you click on the ones, it'll tell you when it's due. So if you're ever wondering, gee, is anything due? If you click on these, it'll tell you when it's due. And then you can submit it any way you want to do it. Okay, now if you you can do it right in the document itself, type it in. You can also scan it. That's fine. If you don't have a scanner, you can take pictures of it, and you can load the pictures in as many as you want. There's unlimited amount of submittals. So if you have 10 pages, you can take a picture of 10 pages. Put it, or you can take a picture of your notebook. You know, you did it in your notebook, take a picture of your notebook, submit it. You know, and again, now do not zip the files and don't put them into page files if you're using an Apple. If you're using Apple, if you want, you can convert it into PDF files, and that's really neat. You can take a bunch of pictures and make it into a PDF file. You can probably do it in Android. I'm not sure, to be honest with you, but I know that in Apple they can do it. So take pictures. So either submit all the pictures separately or put them into a PDF file, but do not send zip files. Blackboard doesn't like them. And also, if you're using the app on a phone or a pad or something, just know that sometimes there's problems with it. The app is not as foolproof as it should be. And I don't mean foolproof, I should say it's not as good as it should be, because a lot of times what it'll do is it hangs up when it's submitting for whatever reason. And here's the real irritating part that's it's hard to figure out what to do. And it's that it shows it as loading continuously, like for a month, and I can't stop it. So it has to be stopped by the student. So, and I tell you this because if you're doing it in other classes too, if you're trying to submit stuff using the Blackboard app, if your professor's saying that they didn't get it or whatever, it's very possible that it's because of that app. And I wish it wasn't like that, but for whatever reason it can be. So anyway, any way that you submit it, I'll take it. Yeah, any questions on that? Okay, and this video will be posted hopefully by midnight. And actually, YouTube was much quicker this week than it was last week so far. So hopefully, fingers crossed, it'll get up quicker tonight than it did last week. Okay, any questions? Okay, so those are the two things to turn in. This one you should already have done. This one you probably have to finish up the last two, and actually the last three, and submit that, and that's it. Any questions? All
No
right.
question.
All right. I'll see you guys next week then.
Okay, bye.
Bye.
Thank you.
Yes.